There is a September that a lot of people over 60th don't really get to experience. It is the quietest month on the retirement calendar. Open enrollment is not yet in. Tax time is 3 months away. The COLA has not been announced. Just a couple of envelopes in the mail and a slower week at the drugstore. But under the quiet, September does more work than probably any other month of the year. Decisions are being locked in right now that you spend all of next year inside, and in some cases, considerably longer than that. The issue is that almost none of it tells you it is there. It shows up as paperwork that looks like junk. It shows up as a date on a government calendar that nobody is even going to send you a reminder about. It shows up as a balance on a card in your wallet that is quite content to quietly reset itself to zero at the end of the month. I am going to explain to you 7 of them right now. And I want to be a little bit clear about what this is not. This is not a list of proposed pieces of legislation, and it is not a rumor about what checks have been or will be cut. Everything on here has already been decided, has already been scheduled, and is sitting on a calendar someplace. 6 of the 7 you can still do something about. 1 of them you cannot. That one is being decided as we speak, entirely without your input, and I will explain why it still matters enormously that you understand it. The folks that come through September in good shape are not any smarter than everyone else. They are not any better with money. They just opened the envelope. The envelope we will begin with. The first thing that happens this month is that every single Medicare Advantage plan and every Part D drug plan in the country is required by law to mail out a document to you called an annual notice of change. It is in your hands by September 30th every year. Every single year. No exceptions. Now here is what that document actually is, because it really does not do the name of it much justice. The annual notice of change is your insurance company telling you in writing and in advance every single thing that they are going to do to you next year differently. Which of your prescriptions are moving on to a higher tier? Which of your prescriptions they are dropping entirely? Which doctors are leaving the network? What your new premium is going to be? Whether your dental coverage or your vision coverage or your over-the-counter allowance is being trimmed back. It is genuinely the single most valuable piece of mail you get all year. And it arrives just looking like every piece of insurance junk you have ever thrown away. Thick envelope, small print, disclaimer on page 1. So here is how it typically goes. It arrives in September, it goes on the counter with the catalogs, and it gets recycled unopened sometime in October. Then comes the second week of January, and you go to refill a medication you have been taking for 6 years, and the pharmacist tells you it is now $240 instead of $35. And you say, "No one told me." Well, they did tell you. In September, you just did not open it. When yours arrives, there are a few things to look at, and it takes maybe 20 minutes. The first is to take your actual bottles of pills to the kitchen table and check each of them against the new drug formulary. Not from memory, the bottles. You are looking for 2 things: a medication that has moved on to a higher tier and a medication that has just plain vanished from the entire list altogether. A drug that has moved from Tier 2 to Tier 4 that can easily translate to $50 to $100 more a month. A medication that has gone entirely means you need a different plan, or you need to start now, while there is still time for there to be a prior authorization exception for it. Second is to check that you are still in network with your doctors. Network changes take effect January 1st. If your cardiologist is leaving your plan, you want to know that before open enrollment opens on October 15th, not after. Third, look at that premium, and do not do the math monthly, do the annual math. $15 more a month does not sound like anything. That is $180 a year. Here is why September matters rather than October. Open enrollment runs from October 15th to December 7th, and once that closes, you're locked in for the entire calendar year. Most people first read their notice during open enrollment, and it is a rush, while everyone else is trying to make the same decision. September is the only stretch at which you both have the information and no time pressure whatsoever. This is also the last quiet month for free help. Every state runs a program called SHIBP, the State Health Insurance Assistance Program. Trained counselors who do not sell insurance and earn no commission on what you choose. In October and November, they are swamped. In September, you can usually get an appointment in a couple of days. Call 1-800-MEDICARE to find yours. So that is the piece of mail. Now let's talk about the one thing on this list you cannot touch. September is the third and final measurement months for next year's Social Security Cost of Living Adjustment. Now, here is how the COLA is actually built, because it is far simpler than most people imagine. The Bureau of Labor Statistics tracks an inflation measure called the CPIW across July, August, and September, and compares that 3-month average to the same 3 months a year earlier. That percentage is your raise. No committee, no vote, no discretion. It is arithmetic. July is in, August is in, September is being collected right now as you watch this. That figure comes out on October 14th, and Social Security announces it, same morning. The current projections from the groups that tend to track this closely are somewhere between 3.4 and 3.8. The Senior Citizens League is at the top of that range. AARP's analysis is a little closer to 3.5. On the current average retirement benefit of roughly $2,086 a month, that works out to something in the neighborhood of $70 to $80 more a month starting in January. And normally, that is where a video like this can end. Good news, you are getting a raise. See you next time. But there is a second half, and it is a second half that almost nobody connects, and that I want you to hear. The thresholds that determine whether your Social Security gets taxed have not moved since the 1980s. If your provisional income is over $25,000 as a single filer, or $32,000 as a couple, part of your Social Security becomes taxable. Those numbers have been written into law since 1983. A second, higher tier was added in 1993. In the 4 decades since, neither has ever been adjusted for inflation. Not once. Your benefit goes up every year. The threshold never does. So every COLA quietly pushes a certain number of people across a line they were sitting safely underneath. They did not get a new job. They did not sell anything. Nothing changed in any way they would recognize. Their check got bigger, and part of it became taxable for the first time. Provisional income, if you have not run this before, is everything that is not Social Security, plus any tax-exempt interest, plus half of your annual Social Security benefit. If that figure currently sits within about $2,000 of $25,000 or of $32,000, write a note on your calendar for the middle of October. When the official COLA is announced on the 14th, run your numbers again with the new benefit amount. You may cross. It is far better to know that in October, when you can still adjust a withdrawal or shift the timing of a distribution, than to find out in April when the year is closed and nothing can be changed. I want to correct something here, because I have seen this stated incorrectly quite a lot recently. The new $6,000 senior deduction from the One Big Beautiful Bill Act is real, and it is genuinely valuable if you are 65 or older and your income falls under the phase-out. But it does not lower your provisional income. It is applied after your adjusted gross income is calculated, which means it reduces the tax you owe. It does not reduce the amount of your Social Security that counts as taxable in the first place. That distinction matters. If you were counting on the senior deduction to keep you underneath, it will not. It softens the bill. It does not move the line. Now let's move to something with an actual hard deadline attached, and one you already paid for. If you are enrolled in a Medicare Advantage plan that includes an over-the-counter benefit, your third quarter allowance expires on September 30th. That is the card the plan sends you for buying things like vitamins, pain relievers, first aid supplies, dental products, blood pressure cuffs. Most plans load it quarterly, and the critical detail is what happens to whatever is left on it at the end of the quarter. It just vanishes. It does not roll into the fourth quarter. It does not show up as a credit anywhere else. It does not carry over. On October 1st, the balance resets, and whatever you did not spend just ceases to exist. Now I want to be precise about what is happening there. That is not a coupon you forgot to use. You paid for that benefit. It is part of the value of the plan you chose, priced into it. When the quarter ends with money sitting on the card, you just paid for something and handed it back. This happens on an enormous scale every quarter for one reason: nobody sends a reminder. The plan is not going to call you on the 28th to say you have $40 left. So here is the 2-minute version. Turn your Medicare card over, call the member services number on the back, and ask exactly this: what is my current over-the-counter balance for this quarter? They will tell you in about 90 seconds. Then spend it before the 30th. If you are not certain your plan even includes this benefit, that same call answers it. And if it does not, make a note, because when open enrollment opens, it is worth comparing between plans. For a lot of people, it is a few $100s a year in real value. Small thing, 10 minutes. The next one is the opposite of small. The fourth item is the paper check transition, and I really need to explain this one carefully because there is a lot of confused information floating around about it. You may have heard that September 30th is the final deadline for Social Security to stop mailing out paper checks. That is not quite accurate, and the truth is actually more urgent, not less. The legal deadline already passed. Under the executive order on modernizing federal payments, the federal government was required to stop issuing paper checks for benefit payments as of September 30th, 2025. That is last year. That deadline is behind you. What happened after it is the part that matters. Following some pushback, Social Security did not cut anyone off. They kept paying the small group who had not switched over and have spent the last year running outreach through phone lines and field offices to try to move people over. They have also been clear that this accommodation is not permanent and that they intend on finishing the transition by the end of 2026. So think about the position that puts you in if you still get a check in the mail. The deadline you were warned about came and went. Nothing bad happened. The natural conclusion is that it was never serious. That is exactly the wrong conclusion. You are not on the safe side of a deadline. You are on the inside of a grace period that the agency has said is ending, and you will not necessarily get a personal phone call on the day it closes. There are two ways to fix it, and neither requires a computer. The first is to deposit directly into a bank or credit union account. Set it up through your My Social Security account, or call 1-800-772-1213. Have your routing number and account number in front of you. The second is the Direct Express card, which is a government-issued prepaid debit card built for people without a bank account. Your benefit loads onto it each month. Call 1-800-254-5726. And if neither actually works, there is a formal hardship exemption through the Treasury Department, 1-855-2901-545. But understand how that works. You have to apply for it. It doesn't happen automatically because you did nothing. Waiting and hoping for the check to keep arriving just is not a plan. If you've got a parent or an aunt or a neighbor down the street who still gets a paper check, this is the one on this list worth picking up the phone about on their behalf. Everything else here just costs money. This one stops it. Which brings me to number 5, and this is the one that costs people the most while getting talked about the least. Across most of the country, the window to apply for senior property tax relief closes somewhere between August and October. A lot of counties land on September. Here's what gets me about this one. Every state has something for older homeowners. Every single one. They come in 3 flavors, and people mix them up constantly, so let me separate them. An exemption knocks down the assessed value of your home, so you're taxed on a smaller number. A freeze locks your assessed value where it sits today, so when property values in your neighborhood climb, your bill doesn't climb with them. And a deferral just postpones the taxes, usually until the house gets sold. Be careful with that third one. A deferral is not forgiveness. It usually turns into a lien against the property, and it often collects interest while it sits there. For some households, that's exactly the right tool. For others, especially if leaving the house to your kids matters to you, that's a conversation to have first. Ask what happens to the deferred balance. Ask it out loud and get a real answer before you sign anything. The exemption and the freeze, though. For most people who qualify, those are just good. And most people who qualify have never applied. Not turned down, never applied. Nobody ever told them the thing existed. These programs run at the county level, and counties don't advertise. The freeze is the sneaky one because it compounds. Lock in your assessed value in a rising market, and year 1, it's almost nothing. By year 8, it's real money. And you generally can't go back and claim it. Miss September, you pay full freight for another year, and you try again next fall. So here's your job this week. Go find your most recent property tax bill. The assessor's phone number is printed right on it. Call and ask 2 things. What programs do you have for homeowners 65 and older? And when does the application close? That's it. That's the whole task. 1 phone call, and for a lot of people, it's worth more than everything else on this list put together. Number 6 is a hard date, September 15th, 3rd quarter estimated taxes. This one's for you if you've got money coming in with no tax taken out of it. Traditional IRA withdrawals where you didn't check the withholding box. Some pensions, rent from a property, consulting work, investment income. If that's you, the IRS generally wants that money spread across the year, not handed over in one lump next April. Miss a quarter and you pick up an underpayment penalty. It works like interest, somewhere in the 7% range annualized, and it just runs quietly from the day you missed until the day you pay. But there's a way around the guesswork, and this is the part almost nobody hears about. It's called the safe harbor. If what you pay across the year adds up to at least 100% of what your total tax was last year, you're generally clear on the penalty. 110% if your income was above $150,000. And that holds even if you end up owing more when you file. Think about what that means. You don't have to predict this year's income. You just have to clear last year's number. So pull out last year's return, find your total tax, divide it up, and check that your payments are on pace. 15 minutes and the guessing is over. While you've got that return out, check one more thing. Were your quarterly payments set before the new $6,000 senior deduction existed, or after? Because if you worked them out back in January on the old math, there's a decent chance you're overpaying. And if your income went up this year, maybe you took a bigger withdrawal than usual. This is your last chance to adjust before April surprises you. Number 7, last one. And most of you won't need this. A few of you are going to need it badly. On August 11th, the Social Security Administration added 14 new conditions to its compassionate allowances list, which brings the total to 314. Compassionate allowances exists for diagnoses so severe that the diagnosis by itself clears the legal bar for disability. A standard disability application usually takes 6 to 8 months, and a good deal longer once appeals get involved. A claim flagged under compassionate allowances can come back approved in weeks because the agency screens for those conditions automatically and pulls the claim onto a faster track. Now, the 14 added this month are mostly rare genetic and neurological conditions, some childhood disorders, and a few very aggressive cancers. So for most of you watching, this isn't about your own claim. It's about a grandchild or an adult child, someone in your family who's 6 months into a process that is slowly wearing them down. If anyone close to you got a serious diagnosis in the past year, and especially if their application is sitting in a queue with no word either way, go look at the current list. It's at ssa.gov/compassionate allowances. If the condition is on there, call Social Security and ask, specifically, that the application be reviewed under compassionate allowances. Use the phrase, say it out loud. It doesn't always get caught automatically, particularly on claims that were filed before the condition got added. For a family sitting in that waiting room, That one phone call is the difference between money arriving in a few weeks and money arriving next spring. So that's the 7. And I want to point out what they've got in common, because I don't think it's an accident. 6 of the 7 are not complicated. Not one of them needs a financial advisor or a lawyer or any specialized knowledge at all. Read a letter, make a call, check a website, confirm a number. What they need is for somebody to notice in time. And the whole system is quietly built on the assumption that nobody will. Nobody's going to call and tell you there's money sitting on your card. Nobody follows up to ask whether you read the notice about your prescriptions. Your county is not going to write you a letter saying you've been overpaying your property taxes for 11 years. Left alone, every single one of these ends the same way. Nothing happens, and it costs you. So here's September, laid out by when you actually have to move. This week, 2 phone calls, your Medicare plan's member services line, to ask what's left on your over-the-counter balance, and your county assessor to ask what senior property tax programs they have and when the application closes. By September 15th, if you make quarterly estimated payments, check your total against last year's safe harbor number and send the payment. By September 30th, open your annual notice of change and go through it with your actual pill bottles sitting on the table in front of you. Spend down whatever's left on the over-the-counter card. And if anybody in your household is still receiving a paper check from Social Security, get direct deposit or a direct express card set up. That one is not optional anymore. Then in mid-October, 2 things land. The official COLA on the 14th, which is your cue to rerun your provisional income if you're anywhere near those thresholds. And open enrollment on the 15th, which you'll walk into already knowing exactly what your plan is doing to you, because you read the letter in September. That's the whole difference. Not knowledge, not money, just knowing what month it is. If this was useful, the single most helpful thing you can do is send it to one person who gets Social Security or Medicare. The over-the-counter balance and the paper check are the 2 nobody knows to ask about, and both of them are fixed with one phone call. Tap the like button if you like this video and subscribe to the channel for the next breakdown. I'll see you in the next one.